everyone. My name is Philip Palumbo. I'm the host of the Palumbo podcast, where we interview some of the most successful founders of businesses, as well as economists and market strategists, to hear about their perspectives. Today, we are very lucky to have Veneta Dimitrova join us, who is senior US economist at Ned Davis Research, where she leads the firm's outlook on the US economy and tracks the macro trends that matter most for markets. Her work focuses on linking data-driven analysis of growth, inflation, labor markets, and income dynamics to developments in U.S. equities and fixed income, giving investors a clear framework for navigating the cycle. On today's episode, we'll dig into how she interprets the current macro landscape, what history tells us about past tightening cycles or easing cycles, and how those lessons can inform portfolio decisions going forward. So, Veneta, thanks so much for your time again today. Appreciate it very much. Always have fun having you on the show.
Thank you, Philip. I always love speaking with you, and thanks for having me back on here.
All right.
Like I
Yep.
said, it's always a pleasure.
Yes, 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 and yes. So let's start off first with, which I'm sure people are always wondering about, is what do you think about the economy?
Um, it's a very interesting time to be an economist, right? To be in financial markets. In addition to that, is even more, thrilling. All this volatility, all the policy changes that have been happening over the past year have made it interesting, challenging to translate all of these changes into what they may mean for the outlook going forward, as well as what they mean for financial markets, right? So there's a lot going on this year. The outlook is also just as challenging as last year. We're living through structural changes of the economy, and that is interplaying with typical cyclical behavior. So both of these things going hand in hand is making it a little bit more difficult to disentangle the effects and see what the economy is going to do forward, right? So through all that uncertainty, though, the economy powered through last year. All these fears, including from me about, negative impacts from tariffs, have not yet materialized, at least not to the full extent that was feared initially. I'm not writing tariff impacts off in any way, right? These are all coming. We still anticipate that they will show up even in the cyclical data. But in the meantime, positive impacts from other policy changes, including fiscal stimulus from the One Big Beautiful Bill that was signed last July, are going to provide an offset. And when you net these, conflicting impacts on growth, we still see the economy performing rather well. My outlook is for about 2% real GDP growth in 2026, which would be somewhat slower than last year. Last year, 2025 is tracking to be just about or just above, I should say, 2%, 2.3 to 2.5%. Considering we still don't know what Q4 growth was, right? But knowing how economic indicators have behaved so far, that's what the headline number will show, right? Something above 2% growth. Under the surface of this robust growth number, there's a lot of undercurrents, right? A lot of things are shifting, and drivers to growth are changing. We're conditioned to think that consumer spending will drive always growth, and consumer spending is always very important when it comes to the final number for GDP growth. But last year, the driver's seat was overtaken, if you will, by capex,
Right.
investment spending, right? AI related specifically, but for 2026, even though AI is still in the driver's seat here, we're starting to see signs of capex broadening across other things. And if you look at, let's say, durable goods spending or non-defense capital goods spending outside of aircraft, that has been picking up pace. So there are signs that capex is broadening beyond the information processing equipment and software part of it, and the high tech side of investment. So that's a positive development. And
Right.
here, that's where you see the benefits, and we'll continue to see benefits, hopefully, from fiscal stimulus, the 100% depreciation, the immediate expensing of all these investments is what is driving capex. And over the longer term, we should see, as we have historically, benefits to productivity growth, not just from the technology expansion, but broadly from more investment in capex. And that's really the linchpin of overall longer term economic growth, right? You want to see stronger productivity gains because they are like I said, the linchpin of potential output growth. And you need that for higher standards of living for everyone. In the meantime, however, the thing is that this increase in productivity and investment taking over the economy cyclically feels like the labor market's falling off, right? And this is where the rest of the stuff, comes through: affordability challenges, shorter term or cyclical challenges for the labor market, things of that nature.
Right. So there's a lot to unpack there, which is
There
exciting,
is, yeah.
right? That's exciting. So the one thing, just to kind of things put in perspective, like for me, the reason why I'm forecasting the economy to continue to be strong, which is good for equity markets, a lot of it is really around. I always look at I'm like, okay, stimulus, stimulus, stimulus. There's continues to be, which has been the case now for a long time, this wave of stimulus, which a lot has been driven by the federal government. So when we see our deficits where they are at 1 to 2 trillion, that's really stimulus, right?
It is.
So, and now on top of that, you have two things which you just brought up: the one big beautiful bill that's going to create 50 billion or more. Like literally, money's going to be in people's accounts that they're going to see from overtime from last year, tips and things like that. So that's really right away, that's federal stimulus. And then you have all this, like you said, the capex spending from the private sector, which is additional stimulus. So this stimulus, I mean, you're stimulating the economy, which is why we're seeing some of these GDP numbers and forecasts continuing to. It's been coming down on the federal end of GDP, but overall it's 3+ percent growth is what we're looking at. And that favors earnings for companies overall. So I just want to kind of put that in perspective. Now, first of all, any comments about that, or you agree?
No, I do agree. Stimulus has become, a constant refrain that is coming for the overall economy from the federal government, right? I mean, we haven't seen anything like it historically. We've mentioned that before. I think last year when we had that conversation, we made the same point that in an expanding economy, 6% deficit to GDP is not normal. It's typically much smaller than that, and given projections for budget deficit and debt going forward, it doesn't look like we're moving away from that now, almost like a new normal. Persistent, high deficits to GDP. The Congressional Budget Office is projecting similarly,
Right.
that, yeah. And one big beautiful bill is part of it. Yeah,
Right.
tariff revenue, if sustained, will offset some of that cost. But, as imports decline because of tariffs, so will tariff revenue. So at the end of the day, it's not a perfect offset to, already in law government spending.
Yes, I agree with you. I'm going to get into some negative stuff. We're going to stay positive for a little while. And
Oh,
then
no,
we'll
no,
change it over to
I'm not.
negative.
I'm an optimist by nature, Phillips.
And so am I. And I don't think anybody should be any other way. I love people like you and others that are like that, because I believe in that. It brings great energy to the party. So I want to dive into this productivity idea. When people hear productivity, I mean, I think they understand it, but maybe they don't as much. So, and if Veneta, if we can break this down as simple as possible. So what we're saying is that we believe that AI will make people, when we say people, we mean employees,
Mhm.
more, or the labor force, more productive per unit of output, right? Which means that, I mean, again, if we break it down simple, if one person was making one widget, now because of this AI boom, they're able to make one and a half, right? That's what we mean by increase in productivity. So I'm going to stop there real quick. We're going to go take this in stages. So do you agree? Is that correct the way I'm saying it?
Yes, it's productivity is output per hour of work. So yeah, technically it is like you explained it. How much you can produce, how much current employees can produce with existing technology. When the technology changes and allows those workers to produce more without increasing the hours of work or number of workers, then that's a productivity gain.
Correct. Okay, good. Perfect. So now when you get that productivity gain, right, you get GDP rises, correct?
Yes.
It rises because you have more output.
Well, yeah, that's one part of the productivity gain, right? You produce more, so therefore that's counted as part of GDP and output grows. And it grows at a smaller cost because your inputs to production now technically are smaller relative to the output you're giving out, right? You haven't increased the hours of work or the employees doing it, and increasing the other inputs to production like technology is a sunk cost. It's a one-time expense that then delivers over
Right.
time. So that's how you get the productivity gains.
Right. So again, I'm simplifying this, I know, right? So if you go back
Yeah.
to what I said before, if you're a company that was producing one widget, per employee, now they're producing one and a half, that means that now, assuming I could get somebody to buy that, right now, that
Mhm.
means my output is more, which means my revenue can be higher as a result of that output,
Yes.
right?
So will your margins if you were able to sell it at the previous price, right?
Correct. Assuming that's right. And that's why I'm saying I'm oversimplifying it, and I agree with you. So the so this productivity boom that we're seeing, so we're seeing this productivity boom mainly because of AI only, correct?
I disagree on that point a little bit.
I agree with you. I know where you're going with this, but go ahead.
Yeah. AI and new technologies, especially general purpose technologies, take time to percolate through the broader economy. AI has been around since, let's say, 2022 when
Yeah.
ChatGPT first came out, right? So now that's like we're going into year 4 here. And it takes about 3 to 5 years to start seeing some benefits. So maybe we're on the cusp of this technology. We know we're on the cusp of this technology broadening across the economy, but it's not. We're not there yet. Certainly in 2026, we'll see more of it, come on board, and more industries will be disrupted by it, like we saw with software, and we're seeing with other industries as well. But it's not yet, broadly accepted. Even with the internet and .com boom in the last century, it took a while. It took a while for those productivity gains to show up, right? There's no doubt they're coming and we'll see more of it. But what we're seeing now is actually, the economy benefiting from, advancements in productivity or new, let's call them technologies. Technology is not just the IT stuff of it. Could be anything, right? The way you manage your business, the way you take advantage of productivity, economies of scale, things of that nature that are not easily quantifiable also fall under the productivity um, um, grouping. So in this case, we're currently bearing the fruit of let's say post-COVID productivity enhancements. It was during that time that we discovered that we could do more with less. People did not have to go specifically to the office to do the same or a better job than they did previously.
Right.
We didn't need as many waiters. Let's say you could put in your order through a little machine on your table in the restaurant, things of that nature. This is a very simplistic way of looking at it, but my point is that AI productivity gains in their full-fledged nature are still ahead of us. This is not it.
And when you look at the last couple of prints on productivity, they were in the fours, and before that, we were in the twos. So we are seeing some movement, and I wonder if that is more as a result of AI. I mean, no, I mean, I know we're early in this, Veneta, and I agree with you, and that's the hard
We are.
part.
We are. But when we look at the quarterly numbers for productivity, we have to think why that is, right? I mean, GDP growth for Q2 and Q3 of 2025 was spectacular, but it was on the back of negative GDP in Q1. There was a lot of volatility in those numbers, and a lot of it was due to the trade policy, right? A lot of preemptive buying, a lot of, inventory restocking, all of these things push up the aggregate number of GDP growth. And at the same time, hiring plans were held back for the very same reason, uncertainty. So that jump in productivity over 2 quarters, I wouldn't necessarily call it the beginning of a new trend. I would like to see a follow through in the year-to-year numbers. In
Yes.
fact, the best way to look at productivity is not just, year-on-year change, but a trend over several years, let's say 3 to 5 years. We are starting to see a modest pickup in that trend, and the year-to-year change is the trend rather is around 1.6% now. This is moving up, but still kind of below what historically productivity gains have been. We've seen stronger. If we move above 2%, that will be fantastic. It sure seems we're moving in that direction, but we're not there yet. Like I
Right.
said, moving away from the quarter to quarter numbers
Right.
is a better way to look at things.
Got it. So, Veneta, why has productivity been so low, which is true for so long?
Well, that's just the nature of the nature of the economy, right? There's always policy changes that may impede productivity gains. Anything that's regulation related slows businesses down, right? That's one reason. So the deregulation push from the current administration may actually help further with productivity gains. So, but generally, it has to do also with the labor force. If you have a labor force that is aging, yeah, we know that the two things are not directly related, but productivity gains tend to follow, stronger labor force growth. You have a labor force that is younger, let's say, that may drive productivity gains just from ingenuity
Right.
point of view, so to speak. So there's different things that can impede productivity growth, but generally what's driving it up the most is technology innovation, just technology inventions, so to speak, and ways you arrange and you run your businesses around it.
Yeah. So the positives of this conversation about the economy is everything we talked about: stimulus, both fiscally and also from the private sector led. Number one, that's big. And then obviously the productivity enhancement, all of that is beneficial to an economy to continue to grow, like we just talked about. Then you have deregulation, which really hasn't come to the system yet. You'll get more and more of that. I think that'll enhance productivity, all positive. So now, so a couple questions as we think about. I want to transition the conversation to the labor market.
Mhm.
Like I said to you before, if you have one employee producing one widget, per hour output, and now you could do 1.5, and assuming there's a buyer on the other side of that to buy that, and all of a sudden revenues go up, and now that company over 5 years has doubled their revenue. And if they double their revenue, they may need to hire more employees because now their company got bigger, right? So there is that element that is possible, but today specifically, again, Veneta, make it as simple as possible we can, right? So the labor market today, we've seen unemployment rate rise, right? And but not to levels we're concerned yet, but off the trough and to where we are now is a little alarming. And then from a layoff perspective, we read the newspapers, people listen to this, read the newspapers, and we've seen layoffs from Amazon and other companies out there. The challenger numbers were challenging, right, in terms of what we saw there. There was some concern around that. And then yesterday's print, we saw a tick down in unemployment to 4.3. So there's been this argument about so our labor force has shrunken, right?
Uh-huh.
It's gotten
Yes.
smaller. So it's gotten smaller because of immigration recently, plus the baby boomer population now officially officially retiring, call it, right? So now we have a smaller labor force. So this idea about a smaller labor force, that has created an environment that has increased the unemployment rate because there's a smaller denominator. Can you walk me through that, if I'm saying it right, or how we should understand that?
Well, it's not a smaller labor force, it's a slower growth in the labor force. And that's what we saw in 2025, right? I mean, the US labor force is still growing, it's just not growing at a 1% rate. I think it's more like 0.4 to 0.5%, right?
So when you say the labor force growing, you mean that the labor force, the amount of people in the labor force right?
Working and looking for work. Yes.
Working and looking for work
Hmm.
that hasn't been growing as much.
Correct.
But the quantity of people that are looking for work and working, you're saying that has pretty much remained the same.
Well, yeah. In fact, it has increased, right? So there's been a drop in the number of foreign-born workers in the country since well, last year specifically, right? Because that's what we're looking at. This is when the deportation and ICE raids and all that started.
Yes.
1 to 1.5 million fewer foreign-born workers in the Bureau of Labor Statistics data, right? From March to like November, December of last year. That data can be volatile here and there, but the trend is clear, right? And the intentions of the administration are precisely that, to reduce the number of immigrants in the country. And it's not just illegal immigrants. The push has been to reduce
Right.
overall immigration flows, and this is precisely what's happening. So on this, just on net of it, even if the native born population and labor force continue to expand, the overall labor force, including from foreign born workers, is bound to grow at a slower pace. And you compare it to the previous 3 years when, immigration was catching up to the lockdown period. So that there was this like 3 million increase in immigration and all that over a couple of years. It almost feels like a shock. You look at the numbers and you see it exactly like that, a spike through 2023 and then a drop off in 2025. So slower growth in the labor force.
Why is that a problem?
Why?
Yes.
But the main reason for the longer term, for example, labor force is the second linchpin of potential output growth. Productivity growth plus labor force growth equals what the economy can achieve in terms of potential growth. And like I said, the potential output growth is what determines ultimately the standard of living of everyone. So if you don't have a rising labor force, or if it's growing at a meager pace, and your productivity is subdued, then your economy is basically stuck. So the hope here is that if the labor force growth slows down, as it is projected to slow down for the next decade or so, productivity growth will offset some of that slowdown, and we will not be in a worse place than today.
So GDP the GDP number that we have as economy in the U.S., right? So if you have a slowing labor force but output doubles, then that our GDP, ultimate GDP, will continue to rise and will dominate relative to our adversaries or our competitors. So what you're saying is that so in a situation where output productivity doesn't increase, but in labor force shrinks or doesn't really grow as much, then that's when GDP slows, and that's when we can have an issue. So when you have a labor force that is growing, let's say you keep the same exact productivity, but a labor force that's growing, why is that increased GDP? Because more people now have because there's more output, which
Yes,
which increases GDP.
and more spending, right?
That's what
So
I was
the
gonna-
fewer people
more
you
people have
have.
a job, and more people, which means they have more money to spend, which expands the economy, etc.
That's exactly it. So the smaller the population, because we look at GDP in aggregate numbers, right? So if you shrink the number of people spending, then you shrink the number of consumer spending in the GDP accounting, and therefore the aggregate number will come down.
Right. So now, Veneta, we do have an aging population, correct?
Mhm.
So is our labor force going to continue to slow because of that?
That's one of the reasons, right? The two primary drivers to the outlook for slower labor force growth are these: aging demographics and the immigration flow decline.
Mhm.
So I think it was the Congressional Budget Office that was looking at it, but I personally looked into the numbers for our long-term capital market assumptions, because we have to figure out, potential output growth into it there. The aging demographics is not just baby boomers leaving the labor force; it's slower birth rates as well, and
Right.
it's not
Right.
an issue just for the U.S. It's for the developed countries overall. Aging demographics has been a constant a constant factor in the outlooks for growth for the I don't know, the past so many years, and it remains so now. It remains so now. The
Okay, so
immigration changes are simply, illuminating more of the same issues.
yep. So this is, a great one-on-one, education about this, which is really terrific. So now if we now take it to the next level, as far as the biggest concern everybody has, which is around AI now eliminating jobs. And I do believe that old jobs will go to the wayside and new jobs will then be established and you have a rebalancing effect like historically you've always had. And you could always not argue it's true that any major revolution that we've seen in this country, it actually created more jobs, not less jobs, from at least from research that I'm reviewing. But in the short term, there's going to be there's going to be an issue where there's going to be an elimination of certain jobs. So,
Yeah.
what is your personal view about this?
There's great anxiety about that everywhere, right? I mean, we see the disruptive nature that AI could have.
Hmm.
We're not seeing it everywhere yet, everywhere just yet. It is still limited to certain industries, but the potential for disruption is here, and it's huge, right? So, how the labor market will go through it remains to be seen, and it very much depends on the pace with which the AI adoption goes forward, right? If it's labor replacing, then that will have a negative impact in the short term. But if it's labor enhancing, then it will be a positive and not, the sudden stunt to labor markets
Right.
as many fear. So we're going to have
Right.
to see how that technology evolves. But there's no question that it will be disruptive, not just to the way we do business, but to the way we do our work,
So if this
including
is
ours here.
so if this is true, then that means our labor, going back to what we were talking about before, that means our labor force would shrink.
That you wouldn't need as many people to do the job, is what you mean? I mean, the
Yeah.
labor force will technically depend on your population, right? And how many people decide to participate in the labor force. So the labor force participation rate multiplied by the number of people in the country is your labor force, right? But
But if all of a sudden all these people are getting laid off because of AI, what does that mean to the labor force?
well, if they continue to look for jobs, the labor force has not changed,
That will
right?
not change, right?
Right, right. If they drop off the labor force altogether and stop looking for work, then that will be a decline in the labor force. But what are people to do, right?
They have to work,
Exactly.
whatever that means, right? So the
Yeah.
labor force can. So you're saying, which I think is really interesting, labor force can stay the same because those people that lose a job will find something else, whatever that means. So labor force can most likely will remain the same because you're right, right? If somebody who's a white collar 35-year-old loses their job, they're going to find something else. They have to work. So the odds of them just completely dropping out, that would shrink the labor force, right, or slow
Mhm.
down the growth of labor force.
Right.
But really, what slows down the growth of the labor force, we're saying, is not going to be AI. It's more around demographics and
Correct.
also both people being born, newborns, plus baby boomers. That's
The
what slows
cyclical,
labor force
exactly.
and immigration.
Correct.
Right.
The
So AI,
cyclical fear
so,
here is
so just to go back, so you're not concerned that AI is going to slow labor force growth.
no.
Correct. Okay.
My concern is about AI driving unemployment up from a cyclical perspective, right?
Correct.
Yes, and this is where the main concerns are. If I lose my job to AI, will I be able to find another job quickly enough to maintain my standard of living and a way of living? And this is where the great anxiety is. From a financial market perspective, it's not a big deal, right? Because you see, not yet. Because investors see AI as a driving force for margin expansion and greater profitability, and that will be the case if you have markets to sell your products. So demand is still important, right? If the ultimate market for your demand shrinks, then that will not be a great deal, right? But if the market remains the same or expands with lower labor costs and greater margins, then that's great for businesses, for their profitability, for equity markets, things of that nature. So there's always two sides of the coin to look at. And to go back to the labor market, the concern is that if the disruption from AI comes in quickly and it eliminates instead of enhances jobs, then that will cause the affordability challenges we're seeing now
Mhm.
exacerbate,
Right.
and it will cause a social strife of some sort. That it may have unintended consequences beyond just a higher unemployment rate. And when it comes to financial markets, the higher unemployment rate may
Pro-
come with its own side effects for interest rates, for bond returns, and equities will start seeing it differently at that point. Again, from a cyclical point of view.
which is starting to see the long end come down. But
Mhm.
the so the but the key thing is look, my personal opinion is that if you do have the cyclical up move in unemployment rate and you go through a recession as a result of AI, I just think that Congress has to step in at some point. You can't just all of a sudden. There's two parts to this, right, Veneta? One is, well, if all of a sudden every company's like, oh my gosh, I could just lay people off and have the same output or maybe even more output and productivity and increase my margins, and everybody starts doing that all at once, unemployment goes to 8%. Well, that's not good for our economy. It's not good for our country. It's not good for leadership and power, et cetera. So we can't let that happen. So Congress has to step in, is the way I look at it. That's just my personal view, number one. And number two, if I'm a company that says I'm going to lay off 2 or 3 workers to increase my margins, initially great. But now if I have a drop of 20% in sales because we're in a recession, I'm net negative. So that we can't let that happen either. And I'm sure this is all going to work itself out, but I'm just saying it's not as easy as just saying we're going to just lay everybody off and everything's going to be peaches and cream. There's issues in doing that.
Correct.
You
Yeah.
agree?
Yeah, I agree. There's always issues around any structural changes of that nature, right? I mean, the US is, more than other developed countries, current policy, some aspects of current policy aside, still the freest of free capital markets out there, right? So we
Yeah.
let the system decide what is best or not,
Right.
and the economy as well as financial markets always look for a new balance, for a new steady state for the economy. What that steady state for the economy will be in the future is always anxiety building, right?
Right.
Especially when we go through structural changes like we do now. But unavoidably we reach one, or we strive towards one, and we move the economy towards one. And the economy always has this inclination to move towards growth. Recession is and shrinking is not the natural state. We get recessions when there are excesses that have built into the system that need to be cleared out. We get recessions when there are imbalances in financial markets, credit crisis, things of that nature. But without those, recessions are not the normal state of the economy. So calling for one when there are no indications of one is just,
Yeah.
I
Yeah.
don't think just
Yeah.
not good.
Yeah. And NDR does a great job, with monitoring that, which I believe you help out with that as well. So I want to change the conversation to, and that's a really great, explanation about labor force, AI and jobs. So the other concern, if you want to call it, or maybe even good thing, like I think Kevin Warsh to me is he's binary, meaning that for me he's either going to be a complete disaster or he's going to be one of the best Fed chairs that are around there. And my idea about him is that I think he's right about the $7 trillion of the balance sheet that is expanded under the Federal Reserve. That he believes that caused inflation, not necessarily the supply issues with COVID, and which has driven up rates essentially. And he believes, and I believe that he's going to come in there and work with Besson to try to bring down that balance sheet, which will then he believes, and then that's when inflation will really drop to where the Fed wants it to be, and essentially then bring down interest rates, which is an interesting thought process and philosophy, and perhaps that is right? Because if you do actually draw a line of the expansion of the balance sheet of the Fed and interest rates and inflation, it does kind of line up pretty closely. So your personal view about what I just said.
Well, first on Warsh, I agree with you. He has the reputation of an inflation hog, though, so he
Right.
has to work around that to deliver what the president wants. And he has jumped on the wagon of productivity gains, delivering for the
Right.
economy and bringing inflation on their own quickly, if not now. Which therefore gives him the leeway to deliver interest rate cuts as soon as he steps in. Whether that will happen remains an open question now, right?
Of
And
course.
it depends on what conditions are and what markets are doing at the time. There are so many variables that can go around. The balance sheet is something that he has been talking about against for a while, right? I disagree that this is the reason why we have inflation now. You cannot just like pick one part of one factor and ascribe major changes in the economy to it. It's the balance sheet plus all of these other things happening around COVID. The specifically the increase in government stimulus at the time, the disruption in supply chain, all of these things that we have talked about a lot that actually caused inflation. It's not the balance sheet per se. The balance sheet has been expanding since the global financial crisis, right? QE is not from yesterday. Why did we not have inflation prior to 2019? I wouldn't necessarily ascribe the inflation we see today to the Fed's balance sheet. But he is saying that this is an unusual and unorthodox Fed policy tool that they want to move away from. If they do, that will imply, first of all, it will depend on how they do it, right? But assuming they just go on, selling off assets, then that will amount to reducing liquidity to financial markets. And the financial markets do
Right.
not necessarily like that. In fact, they dislike
Right.
the reduction in liquidity. So given the response of markets at the time, if they were to start doing that, then that will mean a possible recalibration of whatever policies put in place. All I'm saying is that one of NDR's mantras, don't fight the Fed,
Right.
will be tested in a big way
Yes.
with the new Fed chair. What
Yes.
we know from history is that around new Fed chair dates, financial markets tend to be more volatile. And we've seen it both on the equity side as well as the fixed income side. Within 6 to 12 months of new Fed chairs stepping in, historically there have been ups and downs in equities, and more drawdowns and bigger drawdowns than historically, right? Same goes for 10-year yields. Let's say they tend to pick up before and in the 3 to 6 months after the new Fed chair steps in. So this all that uncertainty in markets that's maybe showing up in prices for different kinds of financial assets, and that kind of amounts to more volatility this year for equities and fixed income as well than maybe markets have priced in so far.
Which I agree with you, and we can be in the start of that because you're starting to see staples starting to rally here, and more the defensive area of the market. So I think it's almost like setting up for what we can see in like 2 to 3 months. So I do believe we are
Right.
going to see volatility increase. So I have two other quick questions, and we'll wrap it up.
Sure.
Productivity enhancement, does that equal deflation?
Not always. But if you look at productivity growth, it typically, as we spoke before, it means producing more with the same or fewer labor resources, right? So when it comes to unit labor costs that businesses face, those are lower when productivity is higher. Unit labor cost is labor cost per unit of productivity, right? So it's just as productivity goes up, unit labor costs go down. And historically, those have correlated with lower inflation. This is the demand side of the economy, right? When you have lower labor costs and lower inflation, I'm sorry, this is the supply side. I misspoke here, but it translates into better margins and therefore allows businesses to reduce the prices
Right.
we charge,
Right.
right?
Correct.
So,
Right.
and this is what
You hope they reduce the price. So they may reduce the price to be more competitive. Do you think, or right?
That's typically the logic, right? In a competitive market, when you face lower costs
Right.
to gain market share, you reduce your prices, and that's what's driving overall inflation down. Now, this is not the only factor that goes into the price determination here, right? Other costs, including tariffs, which we haven't seen much of yet, are working in the opposite direction. Why we haven't seen inflation pick up in 2025 in a more meaningful way is because a lot of the businesses have held back, either have stocked up before tariffs, so inventories, preemptive buying of inventories, or they have held back on passing through the tariff to their final consumers, which they can only do for so long, right? So eventually we're going to have to catch up to these higher costs, and we'll see some of them show up more in consumer prices, and those are the things that are offsetting the lower labor costs from productivity.
Right, I agree. And then just finally, which are probably on a lot of people's minds, is this consistent debt to GDP that it's gone down a little bit, right? I think it was high, it was like 7, now it's down to like 5.5 maybe. So that deficit GDP issue that we have today, and we don't even have a recession, right? So when we do have a recession, that's only going to exacerbate. And the goal of Besant, what he's talked about in the current administration, is that 3-3-3 policy, 3% of GDP deficit to GDP. So just overall, again, quickly your view of our deficits and our debt, and we've talked about this, you and I, before, and what that means to the overall economy.
I don't see specific plans from the administration to reduce the budget deficit and government debt going forward, right? Everything we've seen so far, except for tariff revenue, has been deficit increasing and debt increasing,
Right.
right? So if there is, a belief that we're going to go back quickly to 3% of deficits to GDP, it must be because the administration believes that growth will be that much higher. But the policies in place work in opposite directions. Stimulus from the one big beautiful bill, but restriction on growth from tariffs, restriction on growth from immigration, but at the same time deregulation that is supposed to that is likely to boost
Right.
growth. So it's all about the net effect. And when I consider all of them, I don't see how any of them will be budget positive, meaning slower budget deficit as a share of GDP. And the biggest parts of the deficit are not changing much. These are Social Security, which is
Right.
demographics driven, Medicare, same thing. Medicaid, yes, the administration is trying to curb that. It will come with its own unintended consequences on the not so well to do households, right? Because imposing additional requirements, work requirements, and all that stuff for Medicaid. They don't have as big of an impact on the budget outlook as net interest payments have, let's say, which are projected to continue to exceed $1 trillion going forward, and other items, like I said, the Social Security and Medicare outlays. So there isn't much policy-wise that looks to be deficit reducing going forward. And from a market perspective, what that means is persistent upward pressure on bond yields.
Yes, exactly. No, I agree with you. And I think the current administration had, they tried, and it's I think it's virtually impossible unless you really cut back on Social Security and Medicare, which are, like you said, in defense spending, which are big chunks of this deficit that we currently have. And I just think
Mhm.
it's really, really difficult, but at the same time it's concerning. I always say it's like, that person on my shoulder here saying, hey, don't take much risk with your client's money, because with these looming deficits we have and debt that we have, historically speaking, this is when crises could potentially happen. So diversification is the key as best as you can, and that's really why it's important from an investment perspective. But
Exactly.
Veneta, as always, this was awesome. I always learned so much from you. I could literally talk to you for like another 2 hours about
Yes.
other topics, but and we'll always stay in touch as always. But thank you so much for today. I really, really, really appreciate it.
My pleasure. Thank you, Philip.